Hi, welcome to FNArena Talks. I'm Danielle Ecuyer, and I'm here today with Rudi Filapek-Vandyck, who has just been presenting to investors on the state of the Australian share market. If you haven't noticed, things have been rather, well, volatile of late, and a few investors are asking some big questions. Dare I say, are we heading for another 1929 crash, which is one of the premises that Andrew Ross Sorkin put forward in his latest book? Rudi, welcome.
Well, it's a pleasure to be here. And while we're at books, I can also show one. This is the one I published in 2015, and that's obviously when I was in Queensland last week. That gave me the opportunity to reflect back on last time I was there. That was in the wake of the book. And there's two things that I highlighted in my presentation. One is that my prediction was that we were going through basically a rerun of the 1920s, which basically means we're going to have a whole decade, if not longer, of a world that's reshaping under the weight of technological innovation. The other thing, of course, is that social inequality, which is also highlighted in the book, that's obviously also becoming very, very prominent. And while that is not a direct influence on financial markets, there's obviously a lot of indirect impacts from that element. But for the sake of today's presentation, or today's interview, I should say, in the follow-up to the presentation, we might want to stay with AI because that has become the dominant technological innovation in our lifetime now. And my presentation essentially centered around change. That's also the title of the book of 2015. And change, I put it in two different categories. One is the financial markets in which we all invest are changing, and the other thing is, which is more commonly accepted, of course, is that the economies, the world as we know it, that's changing too, and both are changing very, very rapidly, I would say.
Okay, is the overarching feature as part of this, and this is a topic that at FNArena we have been writing about and discussing now, probably for the better part of the last 2.5 years, and that is, of course, generative AI, artificial intelligence. Is this the overarching feature that is playing out across both financial markets and our economies at this point in time?
I think it's probably best summarized by me saying AI is not everything, but AI will soon be in everything. And there is more than just a subtle difference in there. If we just stick to the financial markets for the time being, yes, AI is impacting, but there's a lot more happening. ETFs, option strategies, the gamification, hedge funds, and liquidity. There's more short-term strategies than long-term strategies. The demise of essentially of passive investment funds that used to be the direction givers to markets, which is no longer the case. In a very brief format, I think it's fair to say that increasingly short-term oriented money flows are impacting on equity markets in the US and increasingly locally. And that means that we have markets that are much more guided by momentum. And the other thing that everyone can notice in markets is there's an incredibly rapid pickup in volatility. While in the US you see even relative large cap stocks, share prices can move by 30-40% on the day. Can you imagine? In Australia, we've noticed a similar uh, pickup in volatility. In Australia, it started about 2 years ago. 2 years ago, we had a reporting season. I remember it quite vividly in August. That was up until that point the most volatile reporting season that we ever experienced in Australia. And volatility has subsequently only picked up more in Australia. If we look back now, back to August 2 years ago, that was nothing with what we are experiencing now. By now, 20% either way, both up and down, is nothing to be sniffed at. That's almost becoming quite common. And I think over time, if that's not already happening, it's going to change people's perception of risk and opportunity in markets and how to deal with risk. Because under the old regime, this would be quite extreme. But if this becomes the norm, I think people's attitudes in the share market are going to change, and not just the retail investor. I think the same will happen with fund managers and institutions.
What sort of expectations do you have around how their behavior will change as a result of this short-term volatility?
I think the problem is that if you are your typical buy and hold investor, and I would place myself also in that basket, is that you can be in the doghouse with your stocks for much longer than you would like. And while there's not necessarily anything wrong with the holdings that you have, otherwise why would you have them? It because of how the market now operates, basically extreme into the winners and extreme into the laggards. It means that you may not have any returns. And if you're a professional fund manager, that is, that that's going to be a disadvantage when people are going to allocate money or withdraw money out of your fund. So I'm guessing that, I mean, I can't speak for all the fund managers, of course, but I'm guessing that they will increasingly become more short-term tradery as well, because they just have to. The numbers have to stack up. That doesn't even take into account that, of course, in recent years, 80% of them can't even match the index. So that will now become even more important, in particular because they are very, very much not going with the crowd all the time. And that means that almost by definition, they have to choose between underperforming and doing the right thing, or joining the crowd and potentially underperforming less.
Mm. So, if we now sort of transpose it over to what's actually been happening, probably in an underlying stock level, and also what's going on in economies, what's interesting that we've had our own sort of out of season reporting season here in Australia, which created some volatile share price movements. Ditto in the US, we've seen those massive outsized moves in shares. But underlying all of that, I think it might be worth just touching on the aspect when people are starting to debate whether we're in a bubble or not, Rudi, at the moment, particularly in relation to the US market, how much is this performance that we've seen out of technology shares? How much of that is actual multiple expansion, re-ratings of the stock versus actually these companies are generating real earnings growth? And we have possibly seen a similar trend, albeit maybe not to the same extent, but there are those similar tailwinds being made apparent here in Australia.
One of the anecdotes I took to my presentation in Queensland is that I said, when I look at my feed on social media, it would appear that half the world is thinking that the bubble is about to burst. And the problem with that is that that was equally the case last year and the year before that. Um, I guess drawing from history, and there's always differences, there's always similarities, but drawing from history, and given that the fact the market, yes, is made up by people, even if at some point this uptrend in this bull market, in particular in the US and in technology, even if that at some point collapses on its own weight, so to speak, you still have to, as an investor, you still have to question whether that's something to worry about right now, today. Because if you were worried about that 2 years ago, you already missed so much in US equities. Um, one of the historical comparisons I tend to make is that assume this is 1926 or 1996. And in hindsight, we know that the collapse comes in late 1929 and in early 2000, but you're 4 years too early. Is it time to worry when you're 4 years early? We don't know whether we are 4 years early this time around, but at this point in time, and I think I shocked quite a few people in the audience last week, is that if you look at the earnings growth that comes out of those technology companies, predominantly in the United States, given the size of those companies, given how far we are already advanced in this cycle, it's gobsmacking. The numbers are so large So the irony is that if you only look at the share prices itself at face value, you think like it has to be a bubble, yeah? But then you put those earnings numbers, those growth numbers underneath it. And then the irony is that actually at a pure PE level, those sharp growers, they have actually been derated. They have
Mm.
actually, on a relative basis, they are cheaper priced now than they were previously. So it's very difficult to make that whole bubble argument stick up, unless, of course, you think, and I don't think that even the strongest bulls think that those paces of growth that they can continue indefinitely. Of course, they won't be growing at 60, 80, 100% indefinitely. But the counter argument is that's why they're not trading on 40, 50, 60 times PEs. Yeah? They're trading on quite benign PEs comparison with the growth that's being recorded. And that's obviously the counter argument. The other argument is that the spending that is now supporting the build out of AI, it's absolutely enormous. I mean, the numbers are, oh, I mean, you can probably make a point that you can probably stack up dollar bills from Earth to the moon and back, and you may still not have enough dollar bills lined up in terms of how much these guys are going to spend. So I can understand from that perspective too that you get these things like there's never going to be a return. Look how much these guys are spending. They're absolutely gone crazy. What are these guys smoking, etc., etc. But one of the slides I showed to the people is that if you put it into the correct perspective in history, that in comparison to what we've seen in the past, from railroads to the internet to other tech-led infrastructure eras, this is in comparison to the size of the companies, the size of financial markets, and the size of the US economy. This is actually still quite benign. The numbers are relatively low still. And so the conclusion you can draw is that given that the US economy now is much, much, much larger than it was in 2000, not even comparing it to the 1920s, the numbers, of course, have to be larger by default.
Mm.
Same for the largest companies that make up that market. The companies today are multiple times the size of companies back then. So
Mm.
it's not just the numbers. I think there's a context to it. There's a relative comparison, apart from the fact, of course, that the easiest way to dismiss comparisons between now and what happened in the run up to 2000 is that most companies back then weren't even profitable. Uh, and those who were profitable were operating on much lower profit margins. One of the slides, which I think opened up a lot of people's eyes, is that profit margins over the past 2 decades, on average in the US, have gone significantly to the up, much higher. And one of the elements that AI is bringing to the fore is that those margins are projected to increase further. So companies will be trading on much higher profit margins than they were in the past. Point number one. So don't make just a simple comparison because we are talking pears and oranges. And the other thing, of course, is that if valuations are higher, you could make an argument the valuations have to be higher because profit margins are much higher.
Yeah, yeah. Just a couple of interesting things, or just little anecdotes in there. Alan Greenspan back in 1996 said, the markets are sort of showing irrational exuberance. And as you rightly said, that was arguably just the beginning of the internet.com era. And it had another 4 years to run. And equally on the CapEx side, having seen the chart, which is absolutely fascinating because as a percentage of GDP, this CapEx spend, as you said, rightly, is well below what has happened as a historical precedent with those other huge transformative secular changes or megatrends that the US economy and the rest of the world experienced. Interesting this week, just as another little anecdote, Rudi Moshi-san from SoftBank, actually, he's piling a whole lot of money into a massive French data center with Schneider Electric. And his comment was that this time around, this spend is going to be 50 times bigger than the dot-com boom. And whilst we're not going to debate that, I think that just goes to your point around the fact that this is large. It is a massive secular trend, but like all secular trends, it's going to have cyclical aspects to it. Let's maybe now drill down a little bit to a point that I think you made really well in your presentation about AI is not just sector specific now and some company specifics, it's everywhere. And there are going to be some winners and some losers, in the same way as people probably are starting to come around to the understanding that maybe not all software stocks are actually going to be wiped out by AI. In fact, they're going to be using AI to enhance their offering. Do you want to touch on the context of how AI could potentially impact here in Australia and on some of our Australian companies from the perspective of not only spend, which companies are benefiting, but also where we're starting to see analysts pointing to potential efficiencies and gains coming through?
Well, yeah, I think AI is, as I said earlier, AI will dominate the years ahead, whether we like it or not. And there's a lot of people out there that don't like it. But it's good to realize for those people that it will not just be the build out and technology stocks only. I think AI is gradually warming up also in Australia to move into other sectors and other segments of the Australian share market and economy. What we've seen as FNArena, and definitely because we have our eye really fixated on what's happening with this new technology developing, is that increasingly more and more companies are communicating with investors, with their shareholders, and saying, "Listen, we are investing in AI, and we are seeing this and this and this as results." It's very early days, but February this year was the first reporting season where AI started genuinely featuring in Australia. Now, we see that now in the in-between reporting season, the one we just had in April and May, is that pretty much all companies are now talking about AI. I suspect, and I actually predict, anticipate that by August, I think pretty much 80% or so of companies are going to be talking about AI. And for investors, this is important because I think the market will be very keen to reward those companies that are actually reporting concrete results and benefits, and maybe to punish those that are simply spending money and having nothing to show for it as yet. So from that perspective, it's going to broaden, but it's also going to increasingly divide the market in winners and laggards, if you don't want to use the word losers. And that's going to define also the momentum in sectors, momentum in individual stocks. And given that we just discussed how volatile markets are becoming increasingly in reporting season, we're going to see some big swings if they don't hear what they want to hear, or on the opposite, if they are positively surprised by progress being booked by those companies. The interesting part here also is that if you take that to the macro level, that we have now seen 15 or 16 years of grosso modo outperformance by US markets, because that's where obviously where the whole AI story is hibernating and is coming from. But if this broadening happens, then it will also broaden to companies in Europe. It will broaden to companies in Asia and in Australia, of course. And that maybe this might also mean that the outperformance of the US might actually be eroded by other companies outside of technology catching up with the help of AI.
Totally. We've already actually seen a lot of amazing performance coming out of Korea and Taiwan, and also aspects of Europe as well through the memory chip plays and the likes of TSMC and an ASML.
But I think picking up on that one, so far it's all technology led still, or even if it's hardware, but it's actually still in the data centers. But I think what we will increasingly see, and maybe not necessarily in August, but maybe by next year, is that we will see non-traditional users now of AI when they start recording benefits and progress. I think that might completely reshape the momentum in the markets.
No, I agree. I think it's probably an underestimated aspect of how AI is reshaping the world. And as you say, there's a lot of debate that people aren't seeing the benefits. From our experience here at FNArena, it's been an incredible productivity tool, which we're continuing to use, explore, etc. And there are potential for other businesses to also enhance productivity, efficiency, also having a deflationary aspect to it.
Yes, that's a good point. One of the things I try to explain also in my presentation also, when people say it doesn't work, yeah, well, that depends what your framework is around it. I mean, if you have now very high expectations and then that AI is going to give you the perfect solutions, well, from that perspective, yes, it doesn't work. But what people need to understand is there's two things. One is this is very much a technology in development still. So we at FNArena, we're using it as a tool to us. We already have seen the big step forwards, the leaps that AI has made over the past 18 months or so. I mean, 18 months ago, we were thinking like, is this really the big thing? Now we're pretty much convinced that it will be. In 18 months' time, I'm 100% certain this technology will be much, much further already. The other thing which people find difficult to understand is our human mind thinks in linear terms, but this development is going to go like a hockey stick.
Mm.
And that means at some point, this will go into full acceleration. And that's the problem that a lot of people are struggling with. You can't see the future because that hockey stick thinking, and that's basically into blue sky, then we actually don't know where that's going to end up with.
And it's also there is we have this bias for extrapolating out what's happened in the past and that there is naturally going to have the same progression. I guess the key question, the sentiment here in Australia, as you and I evidence on X and just generally, is pretty bearish and quite negative. I guess I have to pose the question to you, Rudi. If we do see a pullback in US equities, which some people are saying is, it's highly likely things are looking overbought, even if there is still great long-term value there. We've got some massive IPOs coming to the US market. Are the likes of some of the laggards around the world, like Australia, like the Europe, like the UK, which have been heavily hit by inflationary concerns around the war in the Middle East, are they going to stand up, do you think, if the US markets pull back?
I'm not so sure about Australia, to be honest. I'm a little bit cautious about Australia because we do have our own idiosyncratic problems over here. And one of them is that outside of resources, there's not much happening in terms of earnings growth. And the irony is that our local technology sector, even though it's not as dominant as elsewhere, is actually amongst the more reliable, better growers locally. It's just that the main fund managers don't need to be in there, and we seriously lag the outside world. In terms of investments, I think the big unknown is that we don't really know how this whole dynamic is going to play out. And I also don't know how best to deal with as an investor with the uptick in volatility, for example. But one thing I am gradually coming towards is that I am now in my own portfolio, I'm steering away from making big conviction calls for the very simple reason that it's almost become impossible to predict, no matter how bad or how good a certain result will be, what the share price response will be. And as we both know, and we witness it now almost on a weekly basis, share price responses can be absolutely like enormous. And so I fear for fund managers out there whose whole strategy is built on taking big conviction calls and then seeing their share price being clobbered. So I think, if anything, as an investor, I think this is the era where diversification and spreading risk over multiple segments and sectors, I think this is coming to the fore. It doesn't have to be in ETFs, it can still be in individual stocks, I think. But risk assessment and taking care of risk, I think, will become increasingly important because because you simply don't know, and you can't overreach in terms of taking risk, because at times you don't even know how much or what particular risk you're taking.
I yeah, couldn't agree more. Just in terms of any key takeaways from your presentation, like just in terms of the feedback from some of the people that saw your presentation, are they all sort of confused by what's going on? Are they flummoxed by the fact that the US markets have had such an incredible rally over from their post-March lows? Any particular takeaways, Rudy?
I called my presentation "The Age of Confusion," and that is because I started by lining up all these different narratives and forces at work. And I think when I started talking about that, I saw a lot of heads nodding in the audience. There are so many conflicting theories, narratives doing the rounds. Momentum swings one way, and something works in the US and not necessarily over here. It's a very confusing time. It calls almost for to keep a cool head, level-headed, and be firm and convicted in what you do. But then obviously, and I do understand that, some of the audience members said, like, Rudy, that's easy to say, but it's not that easy to do, not for us who are not in financial markets every day. Of course, you can't discuss with that, like you understand that, but it's challenging, and I think the word challenge is there for both the professional and the non-professional. It's just what it is. And there's an older lady that came towards me and after the presentation, and she said, "Rudy, I've learned one thing in my life. You have to be flexible and adaptable." And I thought, like, I can't summarize it anything better. I mean, that's essentially what we need to do: be flexible and adapt.
Yeah, I couldn't agree more. And I had the opportunity to speak to George Noble, as you're well aware, and he used to work with the famous Peter Lynch. And I was bemoaning how challenging markets were. And he concurred with your thoughts, Rudy, that if you're finding it hard, I can assure you so are the professionals out there at the moment. So 2026 shaping up to be a challenging year. Rudy, thank you so much for chatting with us. Thank you, everyone, for watching, for listening here at FNArena. If you have any thoughts about what you'd like us to do in terms of more presentations, interviews, we do struggle a little bit in terms of our available time, but we're always open to ideas and any feedback that you'd like to give us. So, from us here at FNArena, thank you so much for joining us.